now we are heading down under because we've just had the latest growth figures from the Australian economy showing a pretty underwhelming growth rate of 0.2%. That was in the last 3 months of last year. A punishing squeeze on household incomes has brought consumer spending to a standstill, reinforcing the view the next move in interest rates will be down in Australia. Let's talk to Mark Humphrey-Jenner, Associate Professor of Finance at the University of New South Wales. Nice to see you again. It's a very familiar tale. I would imagine viewers all over the world are thinking, yeah, we know what they're experiencing in Australia right now.
Yeah, well, firstly, thanks for having me. And you're absolutely right, because the GDP growth was underwhelming, 0.2% quarter on quarter, 1.5% year on year. But it's worse because on a per capita basis, GDP actually fell. It fell 1% year on year, and it fell 0.3% quarter on quarter. So consumers are definitely feeling worse off.
So what is the government or the central bank likely to do about this?
Well, the government has limited levers it can really pull at the moment, and similarly with the RBA, the central bank. So the Reserve Bank of Australia will be looking at both GDP growth, but also more pointedly inflation, because they're going to be really targeting inflation going down under 3%. So in the latest monthly reading, inflation was at 3.4%, which is heading in the right direction, but core inflation is still higher than headline inflation. So the RBA can't really move right now. We're probably looking at the second half of the year. The government has been attempting to do some cost of living pressure relief. However, then that stokes inflation when they do it too much. But also a lot of it's eaten up with other price increases, like on private health insurance, which has really eaten up a lot of the most recent tax cut. So they're very much struggling to resolve the cost of living pressures people are facing.
And is it mainly about that, the cost of living pressures? To what extent is the fact that China is having a very tough time and it's such an important economy to Australia, how is that impacting as well?
China's absolutely impacting things. So China's been in deflation for a little while, both in terms of CPI and PPI. PPI basically in all of deflation for all of 2023, which clearly underlines how far the demand might fall. And the property sector has been facing significant issues, which has manifested in the Chinese government stepping in to stop some of the sales, particularly net sales of securities, of stocks, in order to try to prop up the financial markets. And this is then fed into some particular stocks. So we're talking companies like South32 or BHP or other companies that are heavily reliant on exports over to China. And to some extent, that's why we're seeing the Australian dollar hovering just below 65 US cents at the moment.
OK, thank you, Mark Humphrey-Jenner, for your thoughts on the Australian economy.